You want to start investing? I can help you out. Hey, my name is Alexi and welcome to my channel. Investing may be one of the most important choices that you'll make in your entire life, and here are a few reasons why. First, you have something that a lot of people don't have, and it's called time. Because as great as investing is, the older you are, the less money you can get out of it. And if you never heard of compound interest, well, let me just quickly explain you what it is. As an investor that aims for long-term returns, you should focus on buying dividend-paying stocks. A dividend is a percentage of your investments that will actually go back to you every single year. Now great, you're getting paid to buy something. Pretty sweet, right? Now the next step for you is actually to take this dividend, reinvest it, and actually get more every single time. By doing this kind of investments, you will see an exponential growth in your portfolio. Just like a snowball effect, every time you get paid a dividend, it will grow. At first it will grow pretty slowly, and then it will increase and increase and increase until it will get pretty big. And this, my friend, is what we call compound interest. Reinvesting money you get from an investment to get an exponential growth of income. Also, since you're young, you have actually the ability to take more risk than older people. But this will be the subject of another video. So when will be the best time to actually start investing? In my opinion, the best time is right now, as soon as humanly possible. If you're 20 years old, well, that's actually perfect for you. You have the perfect timing to start investing right now. But I know that spending money on something else than spending it on yourself can be a little bit scary at first. But don't worry guys, this guide is for you. So here are my best tips for you to actually start investing now. By the way, if you're new here, we learn about passive income, personal finance, and investment, so hit that subscribe button to be notified for my next videos. The biggest advice I can give you is that you should always aim for long-term returns rather than short-term speculations. That is also called trading or day trading. Because if you don't know, about 80% of traders actually lose all the investment's money in the first year of trading. So this is kind of the same thing as gambling, so why should you do this? Well, quick answer, just avoid it. We're here to invest, so come on guys. You're not here to try and time the market. What is that? You are here to invest your money consistently, and that will be my next advice. You should invest money on a consistent basis, even if the market is going down, is going up, or is not moving at all. Because the money that you start investing now is here to stay for 10 plus years. So the short-term market volatility, we don't care. And also one thing, if the market is going down, it means that your share that you're buying will actually be cheaper. So that's an opportunity for you to actually buy more shares. And this, my friend, is called dollar cost averaging. This is the action of buying more shares when the price is lower and buying fewer shares when the price is higher. So it will give you an average price that is pretty low compared to all the investment you made. So as I just said, never speculate on the market. Because if you're watching this video, you probably are not a Wall Street expert, and that's completely fine. So am I. Because no one can tell what the market will do in a minute, in 2 hours, or in 2 days. Just know that studies have shown that if you invest money consistently and you don't try to time the market, you will always get a better return. And let me prove this to you by telling you this amazing story. This is the story of 3 friends, Tiffany, Brittany, and Sarah. All 3 saved $200 of income per month for 40 years, for a total of $96,000. They all invested in the same thing, an S&P 500 index funds, which we'll talk about later in the video. Once they bought, they never sold and always reinvested their dividends. But they all had different strategies, and that made different results. Let's start with Tiffany. Tiffany, turns out, had the world's worst market timing. She saved her $200 per month in a saving account, getting 3% interest until the worst possible time. She started saving for 8 years only to put her money in an absolute market peak right before Black Monday and the resulting 33% crash. But she never sold and instead started saving her cash again, only to do the same thing at the next 3 market peaks. Yeah, I know she counted down, but that's alright. Each time she invested the full amount of her saved cash only to watch the market crash immediately after. Don't be Tiffany. With this perfectly bad market timing, Tiffany still didn't do too bad. Her $96,000 she invested over the last 40 years is now worth $663,000. Let's talk now about Brittany, in stark contrast to Tiffany, was omniscient. She also saved her money in a saving account, earning 3% interest, but she correctly predicted the exact bottom of each of the 4 market crash and invested all of her saved cash on those days. Once invested, she also held her index funds while saving up for the next market crash. For this impossibly perfect market timing, Brittany was rewarded. Her $96,000 of saving has grown to $956,000. It's certainly an improvement, but interesting to note that when comparing her absolute worst market timing versus the absolute best, the difference is only 44% gain. And now Sarah. Sarah is supposed to be you. Sarah was different from her friends. She didn't try to time the market peaks. She didn't watch the stock price or listen to doomsday predictions. In fact, she only did one thing. On the day she opened her account, she set up a $200 per month auto investment in the S&P 500 index fund. She then never looked at her account again. Each month, her account will automatically invest $200. She invested at every market peak and every market bottom. She invested the first month and the last month and every month in between. When Sarah was ready to retire, she signed up for online access to her account. She was pleasantly surprised with what she found. Her slow and steady approach has grown to $1,386,000. Even though she didn't have Brittany's impossible perfect ability to know the bottom of the market, Sarah's investment crushed Brittany's by more than $400,000. So here's the recap. They all invested the same amount, but they all got different results. And you can clearly tell that Sarah had the biggest profit of all of them, since she invested consistently money into her account, and that's the way you should do it too. Okay, great. Now that you dollar cost average your account and you also invest consistently, you should focus on buying best quality dividend paying stock. Some that won't cause you any problem, some that will still grow even if the market is doing okay. A few examples of those are Apple, McDonald's, or Pepsi, for example. This kind of company is called a dividend aristocrat. Dividend aristocrats increase their dividend payments for 25 years straight or more, and they never cut their dividend. This way, it will ensure you to have safe investments, and that's the way you should do it. But don't worry, if you are scared to put money into companies and you're scared to actually lose some money on it, you can do just like Sarah and her friends did. Buy an index fund. In my opinion, an index fund is the safest option you can have in the whole market. It is a regroupment of stocks, like a category of stocks that you can buy. And for example, the one we had in the story is the S&P 500, which regroups the 500 best performing companies on the whole market. So it means that when you buy one share of an index fund, in this case the S&P 500, you're actually buying 500 different companies that are actually the best performing on the market. In the description of this video, there's a link to this book, The Little Book of Common Sense Investing by John Bogle, that will explain you everything you have to know about index funds and ETFs. And if you read it, actually for myself, it was a real eye-opener on investments. So go check it out, the link is in the description down below. Now the strategy is pretty simple. You have to hold and hold, yeah, that's it. Buy and hold is the best strategy you can have, especially as a young investor. By investing in dividend paying stocks, this will actually ensure you a flow of passive income that will slowly grow over time at the point where it can actually be bigger than a salary, for example. It means that if you start right now, in maybe 20 or 25 years, you will earn as much as if you are working on a 9-to-5 job. And when you reach that point, you are actually financially independent. And if you don't know, I actually have a full playlist about financial independence that you can go and watch right here. In my opinion, investing in the long run is the way to go. And if you actually start doing it, you are already winning the race. If I don't recommend trading, it's because it's way too dangerous and people are impatient and they just want to spend their money and have fast results. And I'm sorry to tell you this, but this is not how the world works. If you want to learn more about investments and which app you can use to actually start investing, I would suggest going to this video right here that I made a week ago that will help you with that. If you enjoyed this video, leave a like and subscribe to the channel. I see you guys next week. Bye bye.